Welcome to The Explainer. Today, we're breaking down a really detailed report that gets into what's behind the massive, record-shattering surge in gold and silver. It argues we're not just seeing a temporary price spike, but a huge supercycle that could totally reshape investment portfolios heading into 2026.
All right, here's how we're going to tackle this. First, we'll look at the big global forces creating what the report calls a new Gilded Age. Then, we'll dive into gold's role as a geopolitical hedge, and after that, we'll unpack silver's completely different story, which is all about an industrial squeeze. We'll also zoom in on the view from India, and finally, get to the big takeaways, the report's verdict, its strategy, and of course, the key risks you need to keep an eye on.
And you know, this all really boils down to the one question that's on every single investor's mind right now. Have we already missed the boat? I mean, are these crazy high prices the peak, or are they just the start of something much, much bigger?
To give you some perspective, gold hasn't just broken records, it has absolutely demolished them. We're seeing spot prices trading at an incredible $4,757 an ounce.
And for investors in India, that number is even more stunning when you factor in the currency. It translates to a jaw-dropping 1,48,000 rupees for just 10 grams. But you know, silver has arguably had an even wilder ride, blasting through that huge psychological $95 barrier. Just how fast this all happened has caught a lot of people completely off guard.
So, back to the big question. Is it too late? Well, the Strategic Alpha Report's conclusion is completely unequivocal. They say this is not some speculative bubble. This is a fundamental repricing of real assets for a new world, and their final verdict is a clear buy.
So, what on earth is driving all this? The report points to a powerful mix of factors. And for gold, it all starts with its main job in this new era, being the ultimate geopolitical hedge.
First up is the geopolitical risk. A totally unexpected trade dispute has blown up between the US and its key European allies over Greenland. Now, this isn't just a minor squabble. The threat of these escalating tariffs is actually creating cracks in the NATO alliance itself, and you can see markets pricing in this massive new uncertainty by running to the safety of gold.
And second, you got the US Federal Reserve, and they are basically trapped. They're being forced to cut interest rates to stop a recession that could be triggered by these tariffs. But at the exact same time, inflation is just stubbornly high, stuck at 2.7%. This combination is an absolute disaster for real yields, which makes a non-yielding asset like gold look incredibly attractive. And this number right here shows you how the big players are reacting. We're not just talking about regular investors. Central banks around the globe bought a colossal 220 tons of physical gold in just the third quarter of 2025 alone. They're desperately trying to hedge their own reserves against all this instability. They can see the writing on the wall.
Okay, so that's gold. Let's switch gears to silver, because while it definitely benefits from gold's rise, its story is fundamentally different. It's not just about money. It's about a powerful and maybe even irreversible physical squeeze.
And the problem really starts with basic geology and economics. You see, a whopping 75% of the world's silver isn't dug up from actual silver mines. It's a byproduct of mining for industrial metals like lead, zinc, and copper. What that means is miners can't just flip a switch and produce more silver, even when its price is going vertical.
So while that supply is stuck, demand is just exploding. And it's coming from three huge unstoppable trends that are all happening at the same time. First, the EU's new solar mandate is creating a massive shock to demand. Second, every single electric vehicle uses way more silver than a gas car. And third, the build-out of all these AI data centers requires immense amounts of silver for their high-speed electronics.
And this right here, this perfectly illustrates just how tight the physical market has become. We're seeing this rare condition called backwardation. Now, that's just market speak for a serious physical shortage. It means traders are literally willing to pay more to get their hands on physical silver right now, today, rather than wait for a contract that delivers in the future.
Now, if you're an investor in India, this perfect global storm gets magnified and amplified by a really unique set of powerful local factors. The first and maybe most important factor is the currency itself. Because precious metals are priced in US dollars, the predicted fall of the rupee basically acts as a price multiplier. So even if gold's dollar price goes nowhere, a falling rupee is going to push domestic prices higher all on its own.
And on top of that, you've got three domestic shifts just adding fuel to the fire. The government stopped issuing new sovereign gold bonds, which were a really popular, tax-friendly way to invest in gold, so that money has to go somewhere else. There's also widespread chatter that import duties could be raised in the next budget, which is creating a buy-now kind of rush. And finally, you have the rock-solid demand from wedding season, which basically creates a floor under the market that's really hard to break.
Okay, so given this complex web of all these global and local factors, the report lays out a very clear strategy for how investors can think about positioning themselves for whatever is coming next.
For anyone with a higher appetite for risk and growth, the report suggests a more aggressive allocation that actually puts more weight on silver. The thinking here is to use gold as your core monetary hedge, but to allocate 60% to silver to really try and capitalize on that powerful industrial demand squeeze we talked about.
And this table shows you exactly how you might do that. With new sovereign gold bonds off the table, the top pick is buying existing bonds on the secondary market for their incredible tax benefits. For liquidity and just ease of systematic investing, ETFs are an excellent choice. But the report strongly advises avoiding digital gold for any large sums because of high costs, and it recommends holding physical bullion only for specific cultural needs or as your ultimate in case of emergency insurance.
But of course, no bull market lasts forever, and no analysis is complete without looking at the other side of the trade. The report is very clear about the key risks that could derail this powerful trend.
So what should you be watching out for? Well, first, a sudden peace deal or a de-escalation of that Greenland dispute would take a lot of the geopolitical fuel out of the fire. Second, an unexpectedly aggressive pivot from the Fed could send real rates soaring and hurt gold. Third, at some point, these super high prices could simply destroy demand from everyday buyers. And finally, there's always the simple possibility that we're just witnessing the final explosive peak of a multi-year cycle.
So while the report's verdict is a clear buy, it leaves us with this final, really provocative question. Even if you get in on this rally, how will you know when it's time for the final act?